Imagine a world where you can predict economic trends, understand market shifts, and make informed decisions. Welcome to the world of economic indicators. These are statistical yardsticks used by economists to measure the pulse of the economy. They might seem like complex terms, but in reality they're just a way of taking the economic temperature of a country. Take gross domestic product, or GDP, for instance. It's like a scorecard for a country's economic health. Then there's the Consumer Price Index, or CPI, which measures the average change in prices paid by urban consumers for a basket of goods and services. These indicators, among others, play a crucial role in shaping economic policies, influencing our decisions, and even determining our lifestyle. So, while they might seem distant and abstract, these economic indicators are closer to our lives than we often realize. Now that you have a basic understanding of what economic indicators are, let's delve deeper into some of these key indicators. When we talk about the economy's size and growth, we're talking about the gross domestic product, or GDP. Imagine a colossal pie representing all the goods and services produced within a country in a given period. That's GDP in a nutshell. But why is GDP so crucial? Well, it's like a barometer for the economy's health. If GDP is rising, the economy is in good shape. If it's falling, it could signal a recession. So, how do we calculate it? There are three ways: the income approach, the expenditure approach, and the production approach. Each one offers a different perspective, but they all aim to reach the same total. Think of GDP as a giant scoreboard. It keeps track of the economic activity and gives us an idea of whether we're winning or losing the game. So, next time you hear about GDP figures, you'll know it's a reflection of the economy's overall performance. Another crucial economic indicator is the Consumer Price Index, or CPI, which measures inflation. The CPI is essentially a tool that helps us understand how the average price of a basket of goods and services changes over time. It's calculated by tracking the prices of a set assortment of items, from bread and milk to doctor's appointments and movie tickets. This index is a key metric because it directly influences the cost of living. You see, when the CPI rises, it signifies an increase in inflation, meaning that the average price of goods and services is going up. This impacts consumers as it determines how much bang they can get for their buck. Businesses too are affected as they adjust their prices and wages in response to inflation. On a broader scale, the CPI helps policymakers and economists to gauge the health of the economy and formulate monetary policies. So CPI isn't just a number, it's a reflection of how much your money can buy. Now let's talk about the role of the big players, the central banks, and how their monetary policies affect us. Central banks, like the Federal Reserve in the United States or the European Central Bank, have a significant role in shaping a country's economic trajectory. They control the nation's money supply, manage interest rates, and work tirelessly to maintain financial stability. Monetary policy is the tool central banks use to influence the economy. It's like the gas pedal and brakes for the economic car. When they cut interest rates, it's like stepping on the gas, encouraging borrowing and spending, stimulating the economy. When they raise rates, it's like applying the brakes, slowing down borrowing and spending to prevent the economy from overheating. The ripples of these changes touch all corners of the economy, affecting everything from mortgage rates to the cost of your morning coffee. So, you see, these decisions are far from abstract. They matter to each one of us every single day. Remember, when central banks change their policies, it's often a response to what these economic indicators are saying. So, you're probably wondering, how can these indicators and policies possibly change my life? Well, let's delve into that. When you understand economic indicators like GDP and CPI, or the influence of central banks and their monetary policies, you're essentially gaining insight into the economic heartbeat of your country. This understanding can help you make informed decisions about investments, savings, and even career choices. Let's start with investments. If you're considering investing in stocks or bonds, the GDP growth rate can serve as a handy guide. When GDP is rising, businesses are likely to be profitable, which could mean higher stock prices and good returns on your investments. On the flip side, when GDP is falling, it might be a signal to tread carefully. Now, what about savings? Here, the CPI or inflation rate comes into play. If inflation is high, the purchasing power of your savings decreases. Essentially, your money buys you less. So, in times of high inflation, you might want to consider investing your money, rather than keeping it in a savings account where its value could erode. And then there's your career. The health of the economy can greatly influence job markets. In a thriving economy, businesses expand and job opportunities increase. However, in a sluggish economy, companies may cut back, leading to job losses. Finally, let's talk about the value of money. Central banks use monetary policy to control inflation and stabilize the economy. When they increase interest rates, borrowing becomes more expensive, which can slow down spending and investment. On the other hand, when they decrease interest rates, borrowing becomes cheaper, potentially stimulating economic activity. So you see, these indicators and policies aren't just abstract concepts. They can affect the job market, the cost of goods and services, and the value of money. They can impact your investments, your savings, and your career. So, by understanding these indicators, you're not just understanding the economy, you're understanding a part of your life. In conclusion, economic indicators like GDP and CPI and institutions like central banks play a big role in our lives. They're more than just figures and policy decisions, they're the pulse of our economy, a compass guiding us through the financial landscape. Understanding them can empower us to make informed decisions, be it in investing, saving, or spending. So the next time you hear about these indicators or monetary policies, remember, they're not just numbers or decisions, they're signals about the health of the economy and can provide valuable insights for your personal financial decisions.